All right, guys, what's up? Welcome to a new video. Today, we are going to be talking about a little bit of a different subject. Today, we're going to be talking about options Greeks explained, about the actual options Greeks, a little bit different, but the way that everyone should know about instead. I'm not going to go make this video too long. We're just going to jump straight into the slides, and we will start talking about it. So this is explained in very simple terms. Everyone should be able to understand, even if you're a beginner or just starting off in the market right now. Let's go ahead and jump into it. So right here, first slide right here, you have options Greeks are not that important. Beta, gamma, delta, and all that. If you are someone that's really into options trading that wants to pay attention to their numbers on their strike, their expiration, go for it, go ahead. But mainly for me, many others, it really does not matter. What matters most is right here. All you need to know about how theta works, timing, IV, which is implied volatility, open interest, and volume on options. You see a lot of YouTube videos out there that explain how options Greeks works and which means and all that. And it's a lot of information, and it gets really confusing. I never really found that helpful. I just never really got a grip of having all that information in my head. And instead, I got these 5 things below instead, and that actually works a lot better and is much more useful and important. So let's go ahead on the next slide right here. Here you go. What is important? Theta, strike expiry, implied volatility, open interest, and volume. Very simple. 5 things right there. Here you go. Once you get the hang of how 5 works together, you will become a much better options trader. Picking the right option is very important. I will explain that later in the slides, but we will continue on. Here we go. We have a little bit of a left to right order right here. This is a little bit of a summary of what each one means. So theta, options price declines in value over time. The longer your expiration is, the less your premium decays. The closer your expiration is, the faster your premium decays. It's very simple. Everyone should know what theta means. Everyone should have in mind how quick the theta can burn and how slow the theta can burn, especially for further out options. If you have an option that expires within 5 days, it is going to burn much faster, depending on the stock as well. We will dive into that later in the slides. Next up, we have is strike and expiry. This is very important. This is the problem that a lot of people go into, especially with expiration. They see a good setup on, let's say they see a good setup on the daily chart. They end up buying a expiration that expires within the same week, and they end up getting burned because there was not enough time. And then the whole next week later, the setup starts working out. So very important to know your expiration and your strike as well. We will explain more into that. But here's a summary. Picking the right option is a key factor to your success in trading, time frame wise, at the money, out of the money, in the money, etc. IV, implied volatility. This is very important. Everyone will get to know about this one later in the slides. Very important. The higher your option IV is, the quicker your premium moves with the stock share price. 80% is a good deciding factor in my opinion. This is my opinion. 80%, above 80% is higher risk, and below 80% is less risk. Next step is OI, which is open interest. We will explain that later in the slides. Once again, open interest is important to watch. A high OI over 1,000 plus is a good number. Generally, it's safer to be an option that has higher OI and volume in the thousands. Higher OI and volume equals liquidity, which is what you want. You do not want to be stuck in an option where you can't sell or where you can't buy when the move is happening because OI or volume is low. Next up is volume. Same thing with open interest. Higher volume equals more liquid. Volume also determines if bid and ask spreads are wide or not. The higher the IV and volume is, the less spread on the option there is. You do not want this to happen because you're at risk of buying at the worst prices. So volume affects bid and ask. Open interest pretty much affects liquidity. Let's go on the next slide right here. We will start off with theta and then slowly go into the other factors and options. So let's go over this picture real quick. Actually, we'll go over this text real quick and then we'll go into the picture. Theta acts as the most important Greek in options. Think of theta as the closer the expiration is, the faster my value decreases. My value is the premium. Number one, keep in mind, theta can burn faster if you're playing a volatile stock like Tesla, for example. It could be Tesla, it could be Amazon. It can also be SPX. SPX is really a good example, actually. Number two, this is where theta really comes at you. For example, playing a 0-day to expiration, which means it expires in the same day you are trading. So, for example, we buy a 155 call, whatever stock it can be. Let's just say NVIDIA, for example, 155 call on NVIDIA for 155 a share, 155 a contract, with share price at 152.50. You have 3 hours left in the market, right? So let's say you bought this 3 hours before the market closes, and expiration is expiring. It expires in the same day in the market, so it expires after market. If the share price does not move and it does not move higher and it's pretty much stuck in the same level for the rest of the day, or it drops then comes back up at the same price at 152.50, your option value will most likely drop a hefty amount due to theta decay. So theta is very important. The picture pretty much explains it, but I will get into it after we finish reading this. Number three, for example, playing a 5 days to expiration. So let's say you're on Monday. The expiration is on Friday. That's a 5-day to expiration weekly, 5 days to expiry. You have 5 days left in your options expiring. Assume we are on Monday. The stock is stuck and either drops, then comes back up to the same price as 152.50 again. Your option value will likely drop a little bit or either be flat, depends on the stock. If it continues to do the same thing for the next 2 days or closer to date, you will notice your theta to start decaying faster because we are getting closer to the time expiration. So to give yourself some less weight on your shoulders off that theta burn, play some in the money contracts. In the money is very important to know as well. You will get into that soon. The goal of your option is to beat theta by buying at the right time before a breakout or a breakdown and finding a direction instead of watching your theta burn because of your option isn't moving. Make sure you buy time. Make sure you buy a good amount of time. It can be 5 days to expiration. It really depends on your setup as well. If you are day trading using 5-minute to 15-minute charts and you see good setup there, it's okay to buy a 0 days to expiration, but that's a higher risk for people who are beginners or learning stages. I don't recommend doing that. If you are experienced, go for it. You should know what you're doing if you are experienced. If you're not, I don't recommend doing it. I would recommend playing with 5 days to expiration or a weekly, just to give yourself a little bit of an easier weight on your shoulder so that you can understand what's going on and how theta will work during that time. So on the picture right here, we have time decay of an option premium. So this is days to expiration, and this is the option value. So we have 180 days, 120 days, 90 days, 60 days, 30 days, and 0. So let's pretend that these will be shorter term expiration. So let's just say this is 5 days, 10 days, 15 days, 20 and 25, or 30. Option value right here, we'll just pretend that's $500, $1,000, $1,500, and $2,000. Now, let's say right here we bought at 15 days out, or let's say right here we bought 5 days out. We're gonna go up right here, and this will be where our option will be. So if you bought something that's 5 days out right now, this is how quick this is a linear line right here. So it's slowly going down, and the closer we are going to date, you can see the faster we are getting to zero. Zero means your option will be $0, nothing. So 5 days out, $500. We're gonna go right here, and the closer that we are getting to date, look how fast it is right here. It's burning quickly and quickly. If we go farther out, 10 days right here, we have some little bit of a less weight on our shoulder on the theta decay right here. You can see it's not moving as much as 5 days right here. From here all the way down to here. Right here, 10 days to 5 days, you can see it's not moving much. Now let's go to 20 days. 20 days to 10 days, it's not moving much, right? It's less than 10 days. Now let's go to 25 days. It's less weight again, once again. And now 30 days right here, see? So the closer you are to expiration, the faster your theta decay burns. So farther out means it's slowly decaying. Closer means it's going to be going at a faster rate. You can see how it goes all the way down to 0 from 5 days to expiration. So let's say you are trading 5 days or 5 minutes and 15-minute chart time frame. If you are a beginner, once again, by minimum 5 days to expiration or weekly, you can always go 2 weeks out, give yourself some less weight, and learn how it works. If you are doing 0 days to expiration, you should know how quickly it can burn. So this is a good picture right here. If you want to go back over here, I will drop the link to the Google Slides in my YouTube video. Next one up is, why is theta decay an important role in my trading? Theta is also a huge factor in the risk management. Farther out equals less risk and a little bit of less reward. Closer to date, for example, weekly or 4 days to expiration, 3 days to expiration, 2 days to expiration, 1 day to expiration, or even 0, is going to be high risk and high reward depending on how close you are to date. So 0 days to expiration will be higher risk and higher reward. Which path do you want to go? This really is a good question for you. You should know what you want to do with options. If you are a beginner or a learner, I recommend starting off with expirations either weekly or even 2 weeks out to get the hang of how theta works with your trading if you are a beginner or learning stages. Theta also plays a big role in your time frame. The shorter the time frame is that you are on or trading on, determines what expiration you should be picking. If you see a competent setup on the 5-minute chart, a short expiration within the week can work. Again, use your risk management and correct sizing. You should always play with confidence on short-term expirations. A bad play can potentially wipe out days or even weeks of your profits. If you see set up on a daily time frame, your best option would be to pick an option that is either a weekly or even 2+ weeks out to give yourself some time and more chances. So let's go on the next slide right here. How to pick the right option, strike and expiry. This is a very important slide. Please listen to this one. There are many out there that get themselves in a situation where a weekly expiration is ideal for them on a setup that is daily or longer time frame, just to end up losing money and missing out on the actual move from that setup because their expiration that they bought is too short. There are many out there that get themselves in a situation where they pick the wrong strike, whether it's out of the money, or too far out of the money, and seeing their options not move at all while the stock moved and end up losing instead. It's a big problem for newbie traders. even experience sometimes, because not many really know about how to pick the right option, especially for strike and expiry. How to fix this? It's a common sense. Like earlier in my slide, buy time. Number one, buy yourself time. If you want consistency and save a risk of growing your account, the easier way would be buying options with more time than usual for your setups. There is absolutely no problem with buying expiration 2+ weeks out for a day trade. Who doesn't want more chances, right? Who doesn't want more chances? Again, I recommend learners and beginners to avoid playing anything shorter than a week to avoid a miss. Once you get the hang of how theta decay works, and you are confident in moving on and stepping up, go ahead and go with the weekly. And then once you're experienced and you are advanced, go ahead and we can start doing 1 day to expiration, 2 days to expiration. Number two, no matter how small your account is, it could be 1,000, it could be 10,000, 15,000, $20,000 account. Do not ever go too far out of the money. I'm telling you, there's a lot of people on Twitter or Facebook or whatever that do post plays on them posting plays that can be SPY, for example, SPY. Let's say the out of money will be let's go right here real quick on my screen. Let's say QQQ, for example. We will do a QQQ expires tomorrow. We're going to do a very far out of the money. And this is actually a really good way that people do to scam other people or pump their own options. So you can see right here, we have pretty much in the money right here. Purple means in the money. Anything that's below the share price means in the money. Anything that's above the share price is out of the money. A price that's on the share price, the current share price, or anything that's very near the share price means at the money. So it can be 293 or 292. So here's what I'm talking about. No matter how small your account is, do not ever go too far out of the money. I'll show you why. So let's say you're following someone. Someone alerted a buy of their 305 call for 2 cents. Why would they go so far out of the money? Because once you buy this, it has some pretty low open interest and volume compared to what we have right here. So once these big followings on Twitter post their plays, more people, potentially even thousands of people, will follow and jump in the same play and start pumping up this option. And that is when they sell, and other people will start losing money on that, because the person that originally alerted that already sold it before you even bought it, because the followers jumped in and played. Same thing as right here. Even though the saying is all option strikes make money if the stock does go in that direction either way, so it doesn't matter. But the problem is that those that buy far out of the money contracts need more movement from the stock in order to even be profitable than those closer to in the money. I highly recommend in the money or at the money, or sometimes out of the money, not too far though, only as they have a far better chance of a safer risk play. Another big factor into picking the right option for in the money and at the money is by looking at the open interest and volume, which we will go over in the next few slides. So, for example, I'm trading, and you can never go wrong with buying in the money contracts with a decent amount of volume and open interest. You should always have it on your options chain, always. So we have a good amount of volume right here, 31,000, or we'll just say 32,000, 6,800 open interest is very good. 18,000 volume, 1,500 open interest. That's very liquid. You can see how volume does affect the bid and asking prices. So the lower the volume is, it's not going to really show right here because these are in pennies, but right here, for example, you can see how the higher the volume is, the less spread we have on the bid and asking prices. So it's only about a $9 change right here, $9 difference between the bid and asking prices. So you're not really buying at the bad prices unless you're doing the market price and you buy at the asking, which is at 226 right here. But you can always do a limit order and try to buy in the middle of it, 215, 215, 226. Let's say we'll buy at 220 or 221. You will for sure get executed right there. Your best way, the way to go is try to always buy as close as you can at the bid prices. Never at the asking prices unless the spread is like $1 or $2 wide. So always pay attention to anything that's around this area right here. I would say a couple dollars out of the money, and even couple dollars in the money. So as you go, you don't want to go too deep in the money because it can be more expensive and it won't be as liquid. So I would say a few dollars in the money, a few dollars out of the money is good enough. Let's go back in the slides real quick. Why is implied volatility important to watch? IV is a big factor of risk management. Not many people really know about this one. Implied volatility is also a good way to determine a future price movement in stock. A very basic understanding of IV would be high implied volatility equals more expensive premiums and more volatile movements. Low IV equals cheaper premiums and less volatile movements. Yes, you will often notice IV decrease in time as you go farther out of the money. This also explains why I tell everyone to avoid going too far out of the money, because you won't be noticing much profits as a in the money and at the money contract would be when they have higher IV. It's more difficult to be a consistent trader, consistent profitable trader when you are trading too far out of money contracts. A good range of implied volatility percentage will be 50 to 80%. This is a safe area to be playing in a regular movement. But this is also depending on expiration, once again, and the stock, once again, like Tesla, for example, which is why we went over them. Anything over 80%, in my opinion, 80% is my deciding factor. Yours can be 60, yours can be 100, whatever you guys see movements at a faster rate and a slower rate, whatever percentage IV you see, go ahead and make that your deciding factor. It's different for everyone, I would say. See, some people have, everybody has a different risk, in my opinion. So find your deciding factor and see what percentage works for you, higher risk or below or lower risk. Anything over 80% IV is considered higher risk. Next slide. Why is open interest and volume so important? I'm not going to make them separate slides because they both pretty much go together. So we're going to go over it real quick. Do you want to get stuck in an option or a position where there are no buyers or sellers in an option and potentially lose most of your money or some of your money, all because you forgot to check your options, open interest, and volume? This is why you pay attention to them. Very, very important. You should always check open interest and volume before you even buy an option. Like I said earlier in the slide, a number in the thousands of both open interest and volume is considered liquid. It's more than enough to be safe selling your option or even buying your option at good prices. Higher OI and volume also means better bid and ask prices. Liquid options. A liquid means not liquid. A liquid option can destroy you with wide spreads and cause a newbie to buy or sell at the worst prices, causing them to instantly lose money when they enter that position. So this I see this every day. Someone asked me, how come I bought this at 225 when you bought this at 215? They didn't check the open interest. They didn't check the the spread. They just bought at the market price and they bought at the worst prices. Like I said, you always want to check. You always want to do limit order if there is a spread in the option that I'm playing, or if you're playing, whatever that someone else is playing that you are following, you always want to check, make sure the spread is within $1 or $2 or $3 or whatever. If it's $10 difference between the bid and asking prices, it's up to you if you want to buy at the asking price if you're or not, or you can just do a limit order and try to buy at the bid price, not the asking price. And when you're selling, you want to try to sell as close as you can to the asking price. Asking price, selling, bid price, buying. You'll often find mega caps. For example, it can be Apple, Facebook, Tesla, Amazon, Microsoft. Those are mega caps, and even AMD and Nvidia, and ETFs like SPY, SQQQ, SPX, and all that. IWM. ETFs do have normal spreads because they are very liquid and are the best stocks to be trading. So if you are someone that's trading crappy stocks like I don't even know a crappy stock anymore because I haven't even touched one for a long time, but something like I can't think of one on the top of my head right now. But yeah, if you're trading a penny stock or something that's very cheap and crappy quality, you will be noticing how the bid and asking prices are very crappy, and the open interest and volume is crappy. The setups are crappy. Everything could be crappy about those cheap stocks. If you stick to mega caps and ETFs, you will see the best result in your trading, especially with liquid open interest, volume, bid and asking prices, and all that. So maybe you should consider trying mega caps and ETFs as well. That will also help you with better trading and better results in your trading, especially options. Options on cheap stocks or junk quality will destroy you. Now let's move on to the last slide. Now, if you pay attention close to these 5 important Greeks that we just went over in your trading, you will become a much better trader. It will take a few months, maybe even a year, depends on how much time you spend on trading. But it will take some time to get a grip up altogether. Put that in your head, and once you do, you will remember it. You will remember it forever. You will know exactly what you should be looking for each time you buy an option or sell an option, and you will have it in your head every single trade. So you know what you're buying, you know what you're selling, and once you every day, every trade you make, you will check the open interest, IV, open interest, volume, IV, and also you should know about buying either in the money or at the money or a little bit out of the money, not too far out. Once again, yeah, so this is a slide right here. I will put the link to the slides in the description below in the video. If you guys learned anything, please let me know. Any feedback, please comment, and whatever you guys have to say, please let me know. Thank you for watching. If you went this far, I appreciate you. I'll see you guys in the next video. Thank you.